So the Federal Reserve Bank of New York took the lead here. They've released a good bit of information. They're looking for additional information, and they will certainly release it if they find it. On the board side, we were in supporting mode. We provided analytic support, notably about the issues related to the construction of LIBOR. Our staff were in contact with the CFTC in April and May to provide analytical support. And Governor Krosner on the board at that time was in contact with the British authorities and the BBA during May and June. I think it's important to note that following the Federal Reserve Bank of New York.
You are listening to Fed Chairman Ben Bernanke talking about LIBOR right there in his semi-annual address to Congress, the state of the economy, LIBOR, what's going on, QE3, that's what the markets want to hear about. Everything, all that and more. Good morning, folks. This is the Markets Hub. I am Paul Vigna. Glad to have you with us today. We're going to start down in Washington, D.C., where, like I said, the Fed Chairman delivering his semi-annual testimony. He was talking about LIBOR there a second ago. That's a big issue. But the bigger issue, of course, is the economy, the U.S. economy. The Fed Chairman not too excited about it. Nell Henderson, our D.C. economics editor, joins us. Nell, what did you make of the chairman's testimony off the top of your head?
Well, the most important thing, I think, is when you see the stock market plunging the way it did after the testimony came out, clearly there were many investors who were really hoping that he would come out with a very direct, clear signal that the Fed is ready to take more action to support the economy. However, I've got to tell you, reading this testimony, I see him really emphasizing how weak the economy is, that almost all the data that has come out since their last meeting have been very disappointing. And in many ways, many of his comments here, I think, set the stage or open the door to more action without committing himself or committing the other Fed board members. You know, they're going to be meeting, have their next policy meeting on June 30th and August 1st. And he can't get out ahead of the committee and promise they're going to do something. But reading this, it sounds very much to me like he is open to doing more. And he cites several factors. The unemployment rate is still very high, and he says it's likely to come down in a frustratingly slow pace. He cites falling consumer confidence and spending, until today falling industrial production, a slowdown in capital investment. It's all very grim, and that may be another reason why the stock market sold off, is because he doesn't sound very optimistic about this turning around. And there's several other hints I see throughout this that make me think that he is open to it. But of course, we know it's a very divided committee. Since their last meeting 3 weeks ago, almost 4 weeks ago now, some members have come out and said that they wanted to do more at the last meeting. Some have said they're still on the fence, and others are against it. So we're still going to have to wait another couple weeks to see if enough people on the committee want to, if he opened the door, if they want to walk through it. We have to wait and see.
Now, we're going to play for a second. We're going to play in a second here a clip of what the chairman said during his testimony. Let's take a listen to this and see what he said about the economy.
The U.S. economy has continued to recover, but economic activity appears to have decelerated somewhat during the first half of this year. After rising at an annual rate of 2.5% in the second half of 2011, real GDP increased at a 2% rate in the first quarter of 2012, and available indicators point to a still smaller gain in the second quarter.
So there you can see, I mean, the Fed chairman saying things that most people know. The economy has gotten weaker. The second quarter GDP, which will come out in the beginning of August, is not going to be a very good number. But now, you mentioned the stock market dropping like a stone when this report came out at 10 a.m., and it really did. If the economy is getting weaker, if the chairman seems open to some more, stimulative measures, why do you think the market reacted the way it did? What's holding them back? What's holding the Fed back?
Well, look, okay, I'm not a stock analyst. My guess off the top of my head is I might want to sell stocks if the Fed chairman is sounding so negative about the state of the economy and he's not promising to do anything about it tomorrow. But I'm telling you, he made a couple very important comments here. Earlier in the year, if you remember that in January, February, we had very strong job growth. And then suddenly it really seemed to peter out and was very disappointing the last 3 months. And Bernanke and some other members said they didn't want to overreact. They weren't really sure, was there some sort of seasonal adjustment problem going on? Were the data going to kind of sort themselves out? And one of the most important things to me that he says here is that it looks like it's more than just a seasonal adjustment problem, that the slowdown in job growth appears likely to be more fundamental. And that echoes what the IMF said in its forecast yesterday. So that suggests that they're worried about a really more persistent, more serious slowdown in economic growth overall and job growth specifically.
Yeah. Nell, did the Fed chairman put anything on Congress? We all know this fiscal cliff is coming up, and he's talked about this a few times at Congress. Did he really try to emphasize again to Congress that they have to act on all this?
Yes, he has said this many times, the poor man. I don't know if it's going to make any more difference today. It probably won't. But he cites as the two biggest risks to the economy right now are the continuing stresses in Europe, obviously in the Eurozone debt crisis, but also the so-called fiscal cliff. And that's a package of budget policies that are set to take effect at the end of the year that would lead to very sharp increases in tax rates and a sharp cut in federal government spending. And this Congressional Budget Office and other groups have projected that if these take effect as scheduled, it will cause another recession. And Bernanke has said several times that, first of all, Congress should address this and fix these policies so this doesn't take effect, but also that the Fed can't fix the economy on its own. The Fed has really pressed its, pedal to the metal on monetary policy in many ways since the crisis. And it can still do more. And Bernanke and others have said they believe they can still do more, but they're sort of diminishing returns to some of the things they do. And they've got limited options. And I think what he's really calling for is for policymakers to get in and do more to help stimulate the economy. But he's not saying how. I mean, he is not suggesting whether it should be through tax cuts or spending increases or how, but just that they can't. He thinks Congress cannot put off till after the election dealing with these issues. And as we know here in Washington, there is no sign that Congress is going to deal with this before the election.
Right. All right. We have to leave it there. Nell Henderson, thank you. Appreciate your time.
Sure.